Hello, everyone, and welcome to our session today with David Bassanese, the Chief Economist at Betashares. Thank you so much for your time, and we're here today to discuss a number of things, but predominantly the federal budget, which was released just yesterday.
Sure.
So can we talk a little bit about the federal budget? I mean, the obvious thing in my mind is this argument around whether it's inflationary or whether it's deflationary and what that actually means. What's your take?
Look, it's a bit of both. I mean, I guess I've called it the neat trick of the budget where, on the one hand, the government wanted to provide cost of living relief for households. They're feeling the squeeze from inflation and interest rates, which is actually directly counter to what the RBA is trying to do. I mean, why do the RBA raise rates? Because they want to actually slow consumer spending to reduce downward pressure on inflation. So the government can't ultimately just offset that, because it would just be a red rag to the RBA to say, well, we've got to raise rates to counter it. But what they've done is provide that relief, if you like, in a way that actually lowers inflation at the same time, or at least measured inflation. So the electricity rebates, they're not sending us checks, but they're sending us rebates through our electricity bill. It's still money that we end up getting, but it's done in a way that actually technically reduces the CPI, because it reduces electricity prices the way it's done. So you could say, look, that's a mechanical trick, and inflation hasn't really gone down. But ultimately, again, from an RBA point of view, what the RBA kind of cares about inflation, their argument is the longer inflation stays high, the greater the risk it feeds through to inflation expectation becomes embedded. To the extent the RBA government even artificially lowers that measured inflation rate for a year, gives us a bit more wiggle. It reduces the risk of that inflation expectations effect. So it gives the RBA a little bit more comfort that there's less risk of it becoming embedded, and more, when it allows them more time for the underlying reduction in inflation process to flow through from a weaker economy. Having said all of that, it is still stimulus in the sense that, if you don't have to spend as much money on your electricity bill, you'll either save it or you'll spend it, some of which will be spent. And so, to the extent it increases demand and can increase inflationary pressure. But I think ultimately it's pretty marginal. So I don't think if you look at the futures financial markets, for example, the expectation for rate cuts hasn't changed all that much. So ultimately the markets have decided, yes, it's expansionary, but not to a degree that's going to shift the dial in terms of what the RBA is going to do.
Yeah, thank you. Which all things being considered, in light of that being the predominant focus, I mean, they've done a good task of that on the whole.
Yeah, on the whole, on the whole, I mean, again, the way design, it's a neat way in the way they've done it.
Yep.
So the worst would be just to give everyone $300 in the mail.
Yeah. Because that's straight up inflationary.
Yeah, at least you don't get any mechanical offset in lowering the measured rate of inflation. So net would actually add to inflation.
Yeah. I was talking with someone recently. We were talking about stage 3 tax cuts and how, on one hand, they for many of our members, they just can't come fast enough because of having a high level of debt or whatever, and just the cost of living increasing by so much. But on the other hand, the timing of it is actually somewhat regrettable. Like, if we had the foresight to know that we were going to be, like, as the stage 3 tax cuts actually come to materialization, at that time we're going to be vehemently fighting inflation and have super high interest rates trying to curb that.
Yes.
I mean, you'd be pretty brave before an election year to move those stage 3 tax cuts, but it's not like it's nice to have that benefit, but it's not necessarily pushing in the right direction, right?
Yeah, I mean, that is again, at the moment, the inflation is our number one problem, and we're trying to get it down without causing a recession. We're trying to moderately slow the economy, and so to the extent we get these tax cuts, again, it does go counter to that at the moment. You can look at it in two ways. It reduces the risk of a hard landing for the economy because there is more spending power. It is something government and the Treasury have long known. They've known, the RBA have known that these were coming. And so the question this year is, if you look at something like in the budget, there is something called the real household disposable income. So it's in disposable income after taxes allowing for inflation. That's been very weak for the last few years, which has driven down consumer spending. This year or next financial year, so starting from 1 July, that's going to go up something like 3.5%. So it's a nice bounce back in income. Question is all of that, how much of that's going to be saved? Because the budget only assumes 2% growth in consumer spending, which is why overall the economy is only expected to grow by about 2% next financial year. But if all of that income, so we know the income is coming, what we don't know is how much of it is going to be spent.
Yes.
The judgment is a good chunk of it will be spent, but if more of it than we expect is spent, the economy could be stronger, and the consequences for inflation and interest rates, there's upward pressure in those areas. So again, the tax cuts, from a political point of view, and from you wouldn't want to delay them anymore. And there is an economic argument for it. I mean, I'm sure as your clients know and everybody knows, the high inflation, the higher lift in average wages over the past few years, just as compensation for high inflation, has pushed more and more people into higher income tax brackets. Their average tax rate has gone up. The government is effectively just giving back some of that fiscal, what we call fiscal drag. So I think, from a tax equity point of view, it needs to be done. Timing wise, ideally, maybe not now, but I think, we'll deal with it. Yeah, exactly. It's another risk for the economy, but it really comes down to how consumers are going to, what they're going to do with that money.
Yeah. And I know that one thing really intrigued me about this budget, which was around the budget forecast for inflation, because as I understand it, the modelling indicated that, or their view was that we'd be back within that 2 to 3% down by about December, which I find stark because the markets are pricing in rate cuts in April of next year, as is my understanding. So it's hard to anticipate that there'd be rate cuts before we move back into that band. So they seem at odds with one another. Is this a really brave call? What's the situation?
Well, so look, what's happened is that the RBA RBA put out their quarterly statement of monetary policy last week, and they had inflation, coming down. Now, but that assumed no extension of the energy rebates. Because they were rolling over. The government, what they announced in the budget this week was new rebates. So the RBA's forecast didn't assume that they would continue. So the government's been able to say, well, here's the baseline forecast for inflation. Now we add the reduction in inflation caused by the energy rebates, and we get lower inflation. So that's why, I'm sure if the RBA did their forecast of inflation today, they would be lower because of that mechanical trick. Now, I won't get too technical, but that's the headline number.
Yeah.
There's also an underlying measure of inflation, which is the trimmed mean. That doesn't mechanically get adjusted, but so it's not clear that will fall by as much. But that's the difference. And again, I think what we'll see what the RBA ultimately do to their inflation forecast, but I think the financial markets haven't just sort of gone, there's this. Again, it comes back to the fact that the budget is mixed, because it does lower inflation in a mechanical sense, but it does provide stimulus to the economy as well. So the direct effect is to lower inflation, but there are offsetting indirect effects because of the boost to demand. So that's where the markets, I think, of saying, on the one hand, yes, it's good. On the other hand, not. And so they've ended up not shifting all that much.
Understood. The Reserve Bank, in particular, the calls that they've got to make over the next little while. We spoke in early March, and when we did, at that time, there was a pretty reasonable degree of optimism in terms of the trajectory of rates.
Yes.
I mean, if we zoom out a little bit, we had quarterly peak at 7.8 in December of 2022.
Yeah.
We've seen this nice curve on the way down, albeit with a little blip, which was hit on the head quickly with another rate hike. And we've been moving down, but in particular, if we think about the March data and the April data, the February data and the March data, it seems that we've had this this stubborn hold here. We got down to 3.5. Most recent monthly data was 3.6.
Yes.
How do you manage that if you're the RBA, and in particular the fact that only, say, 3 or 4 months ago, we would have said, look, the next hike is just unequivocally down. The next movement is down.
Yeah.
But this is now given cause for people to think about that and say, well, now, if we saw a few more 4 monthly data points, then we've got to completely reverse our view here. How do you play this?
Well, so what we've seen so far this year has inflation has surprised a little on the upside, like, a few, 0.1 or whatever, a little bit higher than the market expected. The rate of decline has come off. But the economy has still remained, consumer spending is still super weak. The labour market looks as if it's slowing. The unemployment rate is starting to drift up. We've just got a recent update where it hit 4.1% in April. So the RBA would say, yes, inflation is proving a little bit more stubborn, but the economy is softening. So at the moment, on balance, it hasn't shifted their view. But so it's that balancing act. If the inflation is stubborn but the economy is weakening, then you'd lower your longer term inflation outlook because of the weakening of the economy. So at the moment, they haven't seen that. And again, the higher you move rates, the greater the hurdle to raise rates more, right? So they did adjust their rates in November. But look, at the moment, I think, my call is still that the next move will be down. But I've got only one rate cut now this year. I'm clinging to one rate cut around Christmas time. The markets have pushed it out to early next year. But I think if we see, particularly given now the budget reducing the inflation numbers, if we see continued downward path in inflation and a gradual uplift in the unemployment rate, I think the conditions will be in place for at least one rate cut later this year. But it's about, as I said, if we get some inflation upside surprises, I don't anticipate that. But I mean, if we did, you can't rule out a rate hike either.
If we move across to asset prices, and particularly in equity markets, where it seems to me like we're coming to terms pretty well with this idea of higher for longer. And I welcome your comments to this. I mean, fundamentally, it seems to me that higher for longer is a reflection of the fact that globally our economies are pretty robust, and so that's good for equity markets nevertheless. So, has it come as a surprise to you that despite this news, that equity markets are still performing the way they are, and what is that? And can you speak to what we're likely to see over the next 12 months?
Yeah, so it's been interesting. So basically, the story of 24, in terms of asset markets, has been we came into the year with aggressive rate cut expectations because the US Federal Reserve, many central banks around the world late last year said we think we're done in raising rates. The next move is down. Markets get excited and they price in aggressive rate cuts. Then the economy, particularly in the US, has been a bit more resilient than expected. The economy's held up pretty well. Inflation surprised a bit on the upside. What do? They push out the rate cut. So they're still there, but they're just not coming as quickly as expected. So bond yields have moved higher. In the US, they've gone from under 4% to around about 4.5%. But as you point out, the equity market has been quite resilient to that because earnings growth has still been pretty strong. Markets are still happy that the economy isn't looking like it's going to tip into recession anytime soon. And ultimately, it's rate cuts delayed, not denied. I mean, they still think they're coming, but they're just coming a little bit later. So the markets have been able to cling on to that hope. So we're, broadly speaking, yes, it is higher for longer in terms of interest rates, but it's more, we're still in the sort of soft landing scenario of inflation coming down without the need for recession. That's what markets are counting. So there's the two negative scenarios would be a hard landing if the economy tipped into recession suddenly, because then we get rate cuts, but you'd also get a collapse in earnings, and the equity market wouldn't like that. Or a no landing where the economy is so strong that they have to raise rates, which increases the risk of an eventual hard landing. So even a no landing scenario is a negative because it increases the risk of the hard landing, if you know what I mean. So at the moment, all amongst this, we're still broadly in a sort of soft landing scenario, and that's why equity markets have held up. But they've had a bit of a pullback in the last month because of that. I think interest rates initially went up and they sort of ignored it. The equity market did, and then they kept going up. So we can't ignore it now. We've got to. So I think it did start to press on valuations. Equity valuations, particularly in the US, are a little bit stretched. They reached 20 times forward earnings at one point. And so I think, push comes to shove, and it did eventually have a negative impact, but not too much of an impact. And in fact, they've already started to turn around again.
Interesting to watch the performance of particularly US equities throughout April. We had, especially early April, had a fairly pronounced fall at that top end, Magnificent Seven that had just been on an absolute tear. We saw that revalue to a point. But I can't help but feel that there was some that we're quite fortunate in the sense that that momentum was short-lived, in part because the earnings reports came out for most of those companies within the next week or two.
Yeah.
But it was very encouraging, nevertheless, like for them to be at those valuations, and there'd be some real concerns about these multiples, but then have the earnings to say, okay, well, actually, those multiples don't look so outrageous, in light of the performance of the business, right? Like these companies right now.
That's right. I mean, they are trading at like above average valuations. I mean, people talk about the .com, but I mean, the market looks similar to for older clients who might remember the .com bubble of the late 1990s. Price performance in many of these stocks was similar, but the nature of the stocks today are a lot different. These are companies that actually have real earnings, real strong business models. The NASDAQ, for example, today is trading at a trailing price to earnings ratio of about 32. Sounds high. It was trading at 70 times earnings in late 1999, so it's nowhere near the same. It always trades at a premium to global markets. It's trading at a bit more of a premium than normal, but certainly not on any outlandish scale. So it's hard to say we're in a bubble, but we're definitely, investors are rewarding good, strong earnings performance in an environment where, they're still counting on interest rates coming down. I think one of the questions going forward is going to be, as you saw in April, I mean, and we saw in 22, for example, when interest rates first went up in 22, it was those tech darlings that got hit the hardest because they do trade on high valuations and they're most sensitive to higher interest rates. And so when interest rates went up this year, they did have a relative performance pullback. But if you think bond yields are more or less going to start going down because central banks are going to start cutting rates, that's going to provide another tailwind probably to those companies. The only counter to that is other parts of the global market, including Australia, look relatively cheap, but we've looked cheap for a while and people are still gravitated to those tech companies. So that's the sort of situation we're in at the moment.
And lastly, I'd love to, please forgive the question without notice, but I'd love to get your sense, particularly around currency, if I may. Like, if you're thinking about the AUD, particularly versus the USD, as it seems to be, we're not going to have the luxury of adjusting our respective interest rates in parity, right? There's the economies are shifting differently. If we blink first, for example, if we're the first to start lowering interest rates, what's the magnitude of impact that we could perhaps see in terms of that currency parity and where the Aussie dollar might go?
Yes, so I mean, look, if our economy suddenly, at the moment, our economy is weaker than the US economy, but we probably have a bit more of unfortunately, a more stickier inflation as well. Now, we have a weaker economy because our households are more exposed to interest rates. More people have variable rate mortgages. In the US, most people have a fixed rate mortgage. It's fixed for 30 years. So they have not been that negatively affected by interest rates. But so, I mean, look, why would the RBA go earlier is if our economy really was at risk of a major downturn. It's not at the moment. It's going through a sluggish period of growth, but it's not in recession. But yeah, I mean, if the RBA had to go early and the growth outlook here weakened, the Aussie would weaken, probably could break below 60 cents. It's hovering around 64, 65 cents at the moment. But at the end of the day, the RBA will do what it needs to do. If it fears a recession and thinks it needs to support the economy through rate cuts, it will do it, even if it does weaken the Aussie and adds to inflation. But it's all part of the mix, right? So, because I think, the inflationary consequences of a weaker dollar are more than offset by the deflationary consequences of a hard landing for the economy. So, on balance, we'll probably still cut rates. But it does depend on the scenario. I ultimately think that the Fed, the thing about at the moment is the Fed raised rates more than we did. The US central bank, their cash rate is 5.25%. Ours is 4.35, so about 100 points higher. So they have more room to cut rates when we eventually move into the rate cut cycle, and which should put downward pressure on the US dollar and upward pressure on the Aussie. So I'm actually bullish on the Aussie on a 12-month view, but that's based on the Fed ultimately cutting rates more than what we have done.
Perfect answer, mate. Thank you very much. It's always a genuine pleasure to have the opportunity.
No worries. Lovely to be with you all.
Things economics. So thank you very much, David.
Yeah. Bye for now.